It's a good start. That's it. You don't notice anything beyond that because the 40 point on the Sensex and 16 points on the Nifty can reverse with flip of within a second now, blink of an eye, and we can be back into the red. But the fact that the world is not reacting to last night's sell-off in US is also telling you that markets know that nobody wants a currency war right now. The last thing the Chinese want is that they want to pick up a fresh bone of contention with the Americans in terms of trade war stroke a currency war, because in a currency war no one's going to benefit. That may be a very positive view, but the fear is that historically when these currency wars have happened in the past, they've really destroyed the market. They've really had impact in the near-term sentiment, because if I look at a parallel, China, when they devaluated the currency by this quantum, it was in August 2015, and that time emerging markets and Dow and the Chinese stock markets, they took a knock of anywhere between 8 to 10%. So we are not there yet, but today I think it's good to see that Asian markets are reacting in a rather matured manner. Prateek Agarwal now joins us. He represents ASK Investment Managers. Prateek, how much more to go? Do you think markets by and large, or prices by and large, have already adjusted global fears, a slowdown and a markdown in earnings, or we still have a lot of headroom left? What happens to the market, Prateek, because of selling and because of redemptions? Let's not get there. But fundamentally, do you think all the slowdown news is in the price?
So the results that have come in are better than what one would have feared, X of autos. So FMCG, PAC, pharmaceuticals, IT, the larger names have done well. So that's a positive to take away from the result season, and I think that's the point of discussion as well in our office, saying we were more fearful. Out of the 33 companies that we were invested in and have delivered results, 10 have delivered better than expected. 12 or 13 have done as per expectations, and only very few have done a tad below expectations. So it's been actually a decent result season. Two valuations on price to earnings are still higher than long period average. However, because bond yields have fallen so sharply, on a valuation parameter like earnings yield to bond yields, we are looking actually cheap. In the past, if this sustains, we should find floor and actually move up. So that is our take on valuation. Good chances that we stabilize here. Do not take it as a day-to-day kind of thing, but let's say 15 days hence, one should be at least here, if not better.
Mindful of what is happening to the Chinese currency? Are you mindful of the fact that now a trade war has become a currency war, and historically when currency wars have happened in the past, no one has benefited?
So correct, world is becoming a more volatile place just now. Indicator after indicator is showing signs of volatility. However, versus earlier times, particularly 2006 to 2008 kind of a period where our integration with the world was of a very high order, because of the fact that the key driver of the market used to be foreign flows. As of now, the driver of the market is to a big extent the domestic flows. A lot of them are structural in nature. As soon as you look at pension and provident fund monies, which keep happening to the top 100 names in the marketplace. So, in some sense, the direction of our indices would be more in tune with the earnings trajectory that our companies deliver versus what is happening in the world. So world will influence us less versus our own performance. That said, if yuan weakens, one should expect the same or something similar to happen to the rupee. It happened yesterday, and the Indian businesses which would either be importing or exporting actually did not make or lose anything significant. So that is again something to be looked at. Ultimately, it is what monies are made in rupees as profits which are going to dictate the level of the market.
Prateek, I must admit that you sound more enthusiastic and optimistic than any of the experts who've been on the show today. But tell me then, I mean, is it time then to keep that buying list ready? And if so, what is it that you'd be buying in this decline?
No, so yes, it is time to get the buying list ready, but the list will figure the good quality businesses which have been able to grow even in tough times like these. I would say the leaders, this is again a difference versus the last period in 2014 or 15, 16 kind of a period. Economy was slowing down, but the smaller companies did very well in terms of earning jumps. That is reverse in this period. The smaller companies are struggling, the larger ones are doing significantly better. And I would keep my focus on the larger names, larger mid caps, large caps, which are able to still grow in such times. I think there the probability of them continuing to grow for a few years is higher. And that is the space that then lends itself to our kind of investing. So we have seen this trend. The largest have done well, delivered growth. The second tier have managed to just about keep the head above water. The third tier, smaller companies have actually degrown. And hence my sense is not still focus on mid and small, rather keep focusing on the larger mids and large.
Sure. I mean, you've given us the kind of company size you're looking at, Prateek. What about sectoral wise? Are there themes that you're looking at, or are you just remaining stock specific then?
Yeah, sure. No, so yes, I missed that. So consumption is something that has held out quite well in this result season. FMCG has delivered more or less as per expectation or better, especially in the case of paints, for example. So that's a space to definitely look at. The other one is financials. Now in between there was this thought that corporate banks do well, etc. I think that move is more or less done. It is back to retail banks. Even the corporate banks are expanding in retail only. The other big thing that has happened is the interest rates have started to move down. NBFCs, the good NBFCs which are as yet in business and are able to get monies, are now getting monies at cheaper rates. Their incremental cost of funding is lower than their average, and we do believe going forward the earnings growth would be supported by NIM expansion as well for these cases. So here the market has compartmentalized itself. The companies which are having issues are simply not getting money. The companies which are good and have had no issues are hence able to get more money as well, and hence a shot at the growth. So the space did get hurt a bit when interest rates were rising. NIMs were declining for them then. Now that has reversed. So actually going gets better for some of the better run NBFCs. NBFCs, banks, life insurance is something which is really standing out. It is not taxed for one. Two, because of the changes that's happening to other asset classes, there would be more focus on life insurance by the selling teams. So the growth in the life insurance space should seem to be strong going forward. It is still under penetrated, need of the hour. So we do believe growth momentum to be maintained in that space. That's another, it's fee based, does not get impacted by asset quality issues, which come with the slowing economy kind of thing. So these are the spaces that have really come up out of this result season.
So Prateek, if somebody gives you money to manage at this GL level, which is after a 10% decline in large cap stocks and a 30% decline in mid cap stocks, and he wants a sense on returns for next 3 years, Do you think this market fundamentally is in a position to offer double-digit returns from here to, let's say, next 3 years? Or that will be a very tough kind of an assessment, a tough kind of an assumption?
No, so I would believe there is a very fair chance of delivering that kind of returns. The next 2 years, FY 2021, are actually good even on the index earnings growth. I understand that we start the year particularly buoyant, and then over the past 7-8 years we have ended the year not so buoyant. But as of now, earnings growth over the next 2 years does seem to be particularly good as per consensus estimates. My sense is, even if you correct for higher valuations, 4 to 5% a year, yet what is left on the table for investors on the index itself would be double digit or more. So I would be positive about achieving 10 to 15% kind of returns on the index, rather than not be positive about achieving it.
Prateek, just wanted your perspective really on how to approach aviation, and this amidst the big overhang of the warring promoters when it comes to Interglobe Aviation. And just this morning as well, the AGM notice actually alleges Rakesh Gangwal saying that there is no truce between promoters, and that is something which was a media planted story. How would you approach the sector now?
So it is a very challenging sector for sure. We have largely stayed away from the same. There are a few thoughts that come in. One, the moving parts are so many that even while you were getting a strong 20% volume growth, till jet was there, people were not able to translate that into profit growth. So that doesn't happen with too many industries. One. Two, this is a business where actually there are no assets. If there were assets, then jet should have been sold. There were frankly no bids. So everything is notional, everything can be given to somebody else, be it your parking slots, your landing rights, your routes, your, and planes themselves are any which way leased mostly. So in case of a business not doing well, the gash can be pretty deep. So it is something which can be a trade to my mind, but to buy and stay invested, the journey can be very, very volatile. So we have stayed away from this space largely.